The crypto bull run has started. Can drive the Bitcoin price to $100,000 in 2024. To know the answer, watch the video until the end. As the cryptocurrency market embarks on a trajectory of breakout and reaches unprecedented highs for the year, it's instigating bewilderment among numerous traditional experts. This perplexity stems from the simultaneous existence of two significant and conflicting narratives currently unfolding within the market landscape. One narrative revolves around the imminent launch of Bitcoin ETFs by major institutions slated for the first quarter of the upcoming year. Simultaneously, there's the reduction of new Bitcoin supply by half, an event that inherently signifies an immensely positive trend for the market. The second narrative involves a significant faction anticipating a severe recession in the first quarter of the following year, potentially triggering a substantial market downturn. In this scenario, assets with higher risk profiles such as cryptocurrencies are expected to bear the brunt of this economic downturn. Two major narratives are currently in contention, posing the pivotal question: should we dive in completely now or adopt a defensive stance, anticipating a potential crash? In this article, we'll revisit insights from Raoul Pal, whose research suggests that the substantial crash has already transpired. According to his analysis, this is the time to prepare for an upcoming mega bull market set for 2024. Our exploration will begin by examining the imminent triple cycle expected in the upcoming year, a highly bullish indicator for the entire crypto sphere. Following that, we'll delve into the reasons why the prevailing belief about an impending crash is misguided, the critical factor everyone seems to be overlooking. Finally, we'll conclude by exploring 3 "What if we are wrong?" scenarios, crucial perspectives to safeguard against potential downsides. There's a wealth of critical information to cover, starting with Raoul's explanation about the convergence of 3 mega cycles slated to impact the market next year, setting the stage for a massive bull market in 2024. Triple cycle. The world had an inflection point in 2008, which was the global debt crisis, and we had a debt jubilee. Now, debt jubilees, most people would think of forgiving all the debts. We didn't. We did this magic trick, which we said you don't need to pay the interest on the debt. We'll make it all zero, and every central bank around the world cut interest rates to zero. Okay, that created an opportunity for every government to refinance their debts. So they all refinanced, and they refinanced them in this 3 to 5 year time horizon. And that set off a cyclicality to the economy that we've never really seen before, that every 4 years, we get economic weakness, the increases of the balance sheet and use of interest rates as they come to refinance the debt. So this like clockwork business cycle, which is based around the debt refi cycle, happens to be exactly the same as the US election cycle. It also happens to be exactly the same as the Bitcoin halving cycle. So all of the cycles are at the same time every time. So here we are today. Today, we're at the bottom of the business cycle. This is the kind of recessionary era businesses are laying off staff, inflate. Hence, we witness the convergence of the central bank debt refi cycle, the Bitcoin halving cycle, and the US presidential cycle, all aligning in a profoundly bullish manner, soon to unfold on your computer screens in 2024. Moving on, let's address the prominent concern. The looming prospect of a severe recession expected in Q1 of the upcoming year, potentially triggering another downturn in risky assets. Here, Raoul elaborates on why he believes the prevailing consensus is mistaken and highlights the crucial factor that eludes everyone's attention. Lead versus lag. Forward-looking markets, technology, and crypto price in a recession last year, And they've been recovering since because they've been following the forward-looking indicators of financial conditions and other things. Right now, stuff like the Russell 2000 and oil are living in the present day, which is a slow economy. So they're at their lows and everyone's like, what the hell is going on? Why are these tech stocks going up and everything else is going down? It's because they're forward-looking as it is their job. So I've been very bullish. I saw the liquidity cycle, which is the key driver of all assets. The liquidity cycle is based around this interest rate cycle, which is based around this whole debt refi cycle. Liquidity started bottoming last year in October, November, December, and that gave us the signal to start getting long, both crypto and technology, and that's got people scratching their heads. But our forward-looking indicators of the business cycle suggest we're going into what is right now, we're in macro spring. We're about to start moving towards macro summer. What is macro summer? Macro summer is when interest rates are falling, inflation is falling, and growth is picking up. That's the kind of holy grail for macro and for investing, and we should be in macro stuff. And so the one thing that everyone is missing, which is why Raul believes everyone is wrong, has to do with leading and lagging indicators. The three big risks. The dark view is that the excess manipulation of money blows up the entire system. And that's a lot of people hold that view that you end up with hyperinflation or something of that sort, a total economic collapse. But I struggle to get to that answer because in every circumstance, when asset prices collapse or something goes wrong, they just print money. And when you're the world's reserve currency, bloody difficult to hyperinflate it. So what you end up with is this ridiculous rise in asset prices, which then gets rid of this ability to have this massive downside. Well, we've traded it off for something else, which is everybody's incomes basically get poor in purchasing power over time versus assets. Okay, the other downside people would say, and there's validity to it as well, is that the excess use of monetary policy creates sticky inflation, and that therefore interest rates need to be higher. But I have lived through whole periods of higher interest rates and asset prices still go up. But even if rates stay at 5 for the next 10 years, it's not going to stop people buying technology stocks. Why? Because their ROI is much higher than 5, so nobody cares. Are you feeling more positive or hesitant about the first quarter of next year? And for now, if you did enjoy the video, please hit like and subscribe if you are not subscriber. See you in the next video.